We at the Motley Fool believe that investing in the stock market is the best path to long-term wealth. But it isn't always easy to stick with stocks. Here to talk about how to manage and stomach all the risks so you can reap the rewards is Ben Carlson. Ben is the Director of Institutional Asset Management at Ritholtz Wealth Management, the writer behind the Wealth of Common Sense blog, the co-host of the Animal Spirits podcast, and the author of 5 books, including his latest, Risk and Reward, which will be available on May 12th. Ben, welcome to Motley Fool Money.
Great, thanks for having me.
So it seems to me that one of the main goals of your book is to convince people that they should invest in stocks, but for that to work out, they have to hold on through thick and thin. And the evidence is clear. U.S. stock market always recovers from previous downturns, reaches all-time highs. But people still need the reassurance, right? Especially during the tough times. You know, sometimes even I feel like I need the reassurance, especially as I'm getting older, getting closer to retirement. So why do you think people need that constant reminder? Do you think it's mostly a rational fear? Or is it more one of those behavioral quirks from when we humans were hunters and gatherers being chased around by lions, and it doesn't make as much sense nowadays?
Yeah, that's part of it. It's funny. I did the audiobook for this one for my first time. So my publishers asked, hey, do you want someone else to read it or do you want to do it yourself? I said, I'll let someone else read it, you know? Then I thought, wait a minute. I do the podcast. Now I can try this myself. I'm not like an orator. I'm not really great at these things. I don't like the sound of my own voice, but I'm going to give it a try. And, I've got this other person in my ear who's telling me, hey, slow down, speed up, do that word again, try this sentence again. So it was an interesting experience. And the gentleman who was working with me on the other end, he said, listen, I work for a publisher, but I'm not in the markets at all. And he said, your book is terrifying me. Everything is making me very anxious. Hearing all these bad things that can happen, this is scary stuff. He said, just listening to you talk about it is making me anxious, but I appreciate you, providing the other side. And so I think this is it's something that we can't, I try to get this point across is that, human emotions are not good or bad. It's what we are. Like, we can't really help it, right? And I always say that human nature is like the one constant across all market cycles. And so it doesn't matter how experienced you are with this stuff, you're still going to get those feelings. And that's what I try to convey here is just point out that, like, these things can and will happen. And you have to somehow build them in their plan, just not hope them away that they won't happen at some point, right? So I think that's the big thing is just to provide context around people and show that, yes, I still believe long-term investing in the stock market is your best builder of wealth over the long term, just like you said. But you have to get used to these bad things happening along the way too.
Yeah, but for what it's worth, I saw it as the complete opposite. I saw the book as very optimistic, very realistic about what could happen, but investing in the stock market is the way to go. And I do think that part of the reason, too, is that it's pretty easy for people to look at situations going on and saying, you know what, this time it's different, right? During the dot-com crash, we had valuations at the highest point ever, even higher than before the Great Depression. During the Great Financial Crisis, we had the first nationwide crash in home prices, old banks like Lehman Brothers going out of business, the pandemic, the worldwide economy goes on pause. We're sanitizing our groceries before we bring them into the house. And then today we have AI, right, where we're worried about millions of people losing their jobs and businesses going out of business. And of course, I'm sure many of us have heard the classic John Templeton quote, right? The 4 most dangerous words in investing is this time it's different. But it's still hard not to feel that way, especially when sometimes things are different.
Yeah, it's funny. Templeton actually in an interview before he passed away said, actually 20% of the times things really are different. Right, but your whole point about me being an optimistic person, that I made I've always just been kind of a glass half full person, but it felt like everyone's sentiment after the Great Financial Crisis was really beaten down. I had just started my career. I was 5 years into my career in the markets when the Great Financial Crisis happened, and seeing the aftermath of that, and I saw all these professional investors that I was working with completely, like you said, that okay, this time really is different. What if the stock market doesn't come back and returns are awful from here, and we're living in the new normal, and that's the market that I grew up in the environment, and the sentiment was really beaten down, and everyone was just predicting the next nasty thing to happen, the double dip recession, and we're never going to come back, and Greece is going to take the world down. Remember the Cyprus banking crash and all this stuff, and I thought, well, geez, I don't know. So the stock market just fell 60%. History tells me that's a pretty good time to buy, and I never would have expected we're going to have a 17-year bull market or something coming off of that. But my point was, if you really think that this whole thing is going to go under and not going to come back, then what's the point of investing in the first place, right? So I've always kind of had that more optimistic long-term view, but you're right. You have to be realistic too and understand that the bad stuff comes with the good, and it's kind of like 2 steps forward, 1 step back when you're investing in the markets.
I think another point, of course, is that we all hate to see our net worths go down. You mentioned loss aversion in the book, which is that concept from behavioral finance, which posits that losses hurt twice as more than gains feel good. But you also illustrate that you could be a pretty lousy investor and things could turn out all right. So let's turn to a Ben Carlson classic and hear the story of Bob, the world's worst market timer.
Yeah, which was kind of the inspiration for the book. And I wrote, again, this came out of the great financial crisis, and people worried. And it was funny because in 2013, after 4 or 5 years, we finally hit new all-time highs again, right? Coming out of the great financial crisis. It was like October 2007. And in 2013, we finally hit it again. And at that point, people go, okay, we've seen all-time highs before. Guess what happens? It leads to a cliff. And I wanted to see, okay, fine. Let's play the devil's advocate. Say, you are investing right before a calamity. You invest right before the peak. What happens? So I decided to use this parable of the guy who's the world's worst market timer. And I said, what if he only bought before, a 50% crash in the 1970s, the 1987 crash, and right before the dot-com bubble blew up, and right before the great financial crisis. He only bought then, and he sat in cash between then, but he held on to his shares. Right? How would he have done? If he only bought at the peaks, he got crushed right afterwards, but he held on over the long term. And how over 40 years of investing, how did he do? And the numbers were shocking, and I didn't even know what they looked like before I ran them, right? And I did this back in 2014, and I tell people this is kind of crazy. I look at my stats for my blog every once in a while. Every year, it's still my most read post. People still read it to this day, more than 10 years later, and it's funny that whole concept really resonated with people. Like, oh my gosh, so you can actually make mistakes, but as long as you extend your time horizon, and you keep saving, and you keep investing, and you don't get scared out of the market. That was the whole point. Don't get scared out. You can actually still have pretty good results. And people like that. But the other one was, and again, the whole point of this book was, okay, fine. That was in the U.S. What about elsewhere? What if you were in Japan? What if this? And I get a lot of what ifs from people. What about this scenario? What about lost decades and this? And that was the whole point of the book, is to go through all those caveats and warts and all of long-term investing and then provide some context around them. But it is funny how that one piece still resonates with people in good and bad ways, right? People want to pick it apart, and people want to take it and go, okay, the long term actually is your best friend.
To put some numbers on that, in the scenario, Bob starts saving in the early 70s, retires at age 65, and despite being a horrible market timer, he retires a millionaire, $1.1 million, which is pretty amazing. On the other hand, if he had instead just been dollar cost averaging into the market over that time, he would have had more than twice that, $2.3 million.
Right. Yeah, and the point of that was, my big takeaway there is don't try to overthink this, right? And try to perfectly time when I should put money in and when I should take it out. And if you just consistently put money into the market and kind of diversify your entry points, that's what I like to say about the beauty of dollar cost averaging, is not only that most people do it because that's when they get paid, right? They invest when they get paid. People get paid on a set schedule. They don't sit there with the lumps of money unless you get an inheritance or something or win the lottery. Most people invest on a dollar cost average basis because that's how the world works, and that's how you save over time. You save on a monthly or a weekly basis or whatever. But you diversify your entry points. So one entry point is not going to crush you if something does go wrong. And guess what? It's also a very simple strategy that doesn't require a lot of brain power, right? It doesn't give you a lot of brain damage of trying to pick the right time. And oh gosh, what if I pick the wrong one? And what if this happens? And you don't have to what if as much anymore when you just spread your bets.
So the story of Bob shows that long-term investing historically worked out, and you have all kinds of great statistics in your book showing that, the risk, but also the rewards. Are there one or two facts or figures in your book that you hope really stick with people when they're done reading your book?
The one that's always stuck out with me that I've used a lot is, I looked at the 30-year returns for the U.S. stock market going back to the 1920s. And okay, let's say you actually picked the very worst. You're worse than Bob. You put your money in right before the worst crash in history, and you put your money in September 1929, the Great Depression, right? You put your money in there and you hold it for 30 years. How did you do? Reinvested dividends along the way. And the worst 30-year return that we've seen over the past 100 years in the U.S. stock market is about an 8% return per year, which is kind of crazy. Now you had to live through an 80% crash to get there, right? I don't know how many people actually had the wherewithal and the ability to do that. But it is kind of shocking that even at that worst point in history, you still get an 800% total return, right, from that point. And so I think that one is interesting to me. I really liked the Roger Federer stuff. It's kind of funny. I put two tennis people in my book. I'm not a big tennis person. I never played tennis or anything growing up. My dad tried to get me to play. Didn't really stick with me. But Roger Federer said that he won like 80% of his matches, one of the greatest professional tennis players of all time. But he only won 54% of his points. And those numbers line up almost exactly with the stock market, right? Like on a daily basis, the market is up something like 52, 53, 54% of the time. It's only a little better than a coin flip, that the stock market is up or down on a given day. But you extend your time horizon and you go out 3 to 5 years. Now we're talking about, again, being up like 80% of the time on an annual basis. And I thought that parallel was interesting too, that just the longer you extend your time horizon. I always say that the stock market is the best casino in the world, because the longer you stay in a real casino, the worse your odds of success, right? The house always wins, because the longer you stay, their odds are in their favor. And it's the total opposite in the stock market, which is always funny to me when people compare the stock market to a casino, because if it is, it's the only casino where the house doesn't win if you stay in longer.
One of the facts that I took away from the book, which is sort of related to that, is that we all know that the long-term return of the stock market is 10% since the 1920s. But the number of years that the stock market actually returns anywhere around 10%, between 9 and 11%, very, very low, like 3. So one of the aspects of investing in the stock market is you don't really know what you're going to get in the short term, but the longer you hold on, your range of returns sort of narrows, which makes it easier to plan for things like retirement.
Yes, yeah. And I think the number I give, that the volatility returns, like over 30 years, there's actually a wider range of results in bonds and cash than there is in stocks, which is interesting, right? You're right. It narrows and narrows and narrows the longer that you hold it for. And that other one about the average, like I always say that the average stock market return is never average in a given year. So I think that the average year in an up year for the stock market is like 21%, and the average year in a down year is down 13 or 14%. So it's a really wide range from any given year, and that's one of the things that makes the stock market so interesting and challenging, is because if you could just plan, all right, I'm going to get 10% here, 10%, like it would make your life much easier. Financial planning would be easier, your emotions would be easier, but if the stock market did that, if it was easy, you wouldn't get the risk premium, right? So the stock market has to be volatile like that to give good returns over time, and that's the thing that gets people is getting too high or too low when things are really good or really bad.
You had mentioned the Great Depression, and a lot of the data in your book does start with 1928, so it includes the Depression, which was just horrible, right? And it wasn't just one bear market, it was a series of bear markets. Overall, the market's down 86%, as you point out in the book, that after a loss like that, you have to earn 615% just to get back to break even. And when you see other statistics about historical returns out there on social media or even from some financial services firms, they often start at the end of World War II or maybe 1950, which I think sort of implies that they think, the Great Depression, that couldn't happen again. But you chose to include it, and you point out how bad it was. So you point out that 18 of the 26 worst monthly returns of the stock market happened between 1929 and 1940. So do you include it because you think, well, if it happened in the past, of course we could have another Great Depression? Or do you think we're probably beyond that, but it's still important to include it because it shows that even long-term investing could survive those horrible returns?
Yeah, I think it's worth including because, it's part of the long term. And I think that's interesting too. Like, hey, that 86% crash is the 10% return is inclusive of that 86% crash. But I think it's also, I don't necessarily think it could happen in the U.S., save for an alien invasion or something. But even if we got attacked by aliens, we're probably going to spend on infrastructure, right? So maybe that's a boom to the economy. But it's happened in other countries, right? I think you can look at other countries around the world and have a 70, 80% crash in the stock market. One of the other things I talk about in the book is how ownership has changed over time. And that was one of the interesting things I found about the Great Depression is basically no one owned stocks back then because people couldn't really afford it. There wasn't a lot of disposable income. So the number I found was like 2 to 3% of households even owned any stocks in the Great Depression. So it's kind of a misnomer that everyone lost their shirt and got crushed in the stock market. It was more the economy that really crushed people back then. So I think the fact that the stock market is more important these days, and we've seen that in a crisis period, the Fed and the government is willing to like throw the bazooka at these problems. I guess you could say, well, maybe if they didn't do that, then then all bets are off. But I think that it would be hard to have that happen again. But if you're a globally diversified investor, could it happen in another smaller country? If you are exclusively in that country, that probably could happen, right? They don't maybe not have the as diversified of the economy as we have, or have a central bank that was willing to do this with the global reserve currency. So, but yeah, it's part of the history, and it may be part of the reason that we don't have a Great Depression anymore is because we lived through one already, right? The reason that we had such high fiscal stimulus in 2020 with the pandemic, I think, is because we lived through 2008. So I think there is some like market knowledge that builds on itself. And then you wonder, like, well, are you just transferring these one risks to other kind of risks? And that's the kind of thing I talk about in that chapter is like these normal accidents, like trying to make these complex adaptive systems safer. All it does is you move risk from one thing to another, and it manifests in different ways.
The phrase long term has come up a bit in our conversation, and it's in the subtitle of your new book. But what does that mean for you, right? So what's the time frame for you for which someone says, I need money in this number of years, and you'd say, well, that should be in cash, or I can leave it alone for this number of years, and okay, you're probably going to be okay in the stock market. And I'm sure there's a bit of a gray zone in between those two.
Yeah, I think it's something like probably, if you need that money in 5 years or so, it probably shouldn't be in the stock market because you can have really bad returns over a 5-year period. Most of the time, the stock market is up over a 5-year period, but I think if you're talking about something like a down payment for a house or something, or a wedding, I think you've got to be pretty careful and at least have some sort of diversification there. And I talk about that in the book too, that having an offset to the stock market is a good idea, just so you're not selling stocks when they're down. I think that's a pretty good rule of thumb. Some people would say that's way too conservative. What are you talking about? I can handle that, and maybe it is, but I think personally in terms of like a barbell, like if you need to have that money, I don't want to be in a position to sell stocks when they're down and be a forced seller at a bad time, because I think that's the whole thing about stocks in a bear market is if you have the ability to extend your time horizon, not just buy more in a bear market, but just let it ride and not have to sell. I think that's a big part of it. So I think long term for me is like it's 5 to 7+ years, something like that.
You've touched on international investing a little bit and mentioned Japan. And I'm about, 15 years or so older than you. So I was a teenager in the 1980s, which was just a fantastic decade for Japan, right? And so I remember all the headlines from back then about how Japan was taking over the world. There was worry that U.S. would be surpassed. American companies were being encouraged to take on Japanese business practices. Japanese companies were buying up real estate like the Rockefeller Center and companies like Firestone. But then things changed in 1989, right? The Japanese stock market plunged and it didn't get back to its previous high until relatively recently. You devote 2 chapters to Japan in your book. Tell us a little bit about how crazy things got and what you think the lessons for investors are when they look at what happened in Japan.
When I went to go title this book, I jokingly said to my publisher that I wanted to call it Now Show Japan. That would have been a little too inside baseball, I think. But that is the one thing I hear all the time from people over the years when they push back against the idea of long-term investing. Because I'm a big proponent of long-term investing. And, I'd say in the book that like buy and hold investing is not like a perfect strategy. Like it's just better than all the other ones. That's kind of the way that I feel. But everyone always says, okay, fine, great, buy and hold works, but what about Japan? And I go through to show that, yeah, I really do think that was the biggest financial bubble of all time, because it wasn't just the stock market that was trading at like 100 times earnings. It was the real estate market too, as you mentioned. It was the numbers that I share in there are just kind of hard to believe. And it's funny because the Japanese traditionally, they don't get as high and low as we do. They're pretty even-keeled people. They don't have, they have these long-term businesses that have been around forever, and they don't really have these booms and busts as much as we do. And so the fact that they got pulled into it just shows how strong that can be, that human nature piece. And they didn't, yeah, you're right. They didn't just have a lost decade. They had a lost like 3.5 decades. It was really till last year that the Nikkei finally broke above it. And people always say, okay, fine, smart guy. What about the Japan situation? And I show that, yes, since 1989, 1990, the situation in Japan has been pretty dire. It is kind of interesting, though, that like there's not huge financial strife in Japan because of this, right? They increased their savings. They maybe had more money in cash. Families helped out. They also invested in bonds. And if you were a globally diversified investor, you barely noticed it. Even though Japan was almost half of the world market cap at the peak in 1989, right? It was bigger than the U.S. stock market. And then it went all the way back down to like 5%. So it went from the biggest stock market in the world. Imagine if that happened to the U.S. right now, right? We went from 65% of the global market cap to like 20% or something. You'd think, what happened? How did the rest of the world go on? And if you look at just the MSCI All World, it still did like 9% a year with that happening. Again, inclusive of that. And if you extend I did it in the book, if you extend Japan back to 1970 when the MSCI indexes start, you earned almost 9% per year, right? So maybe I'm extending my definition of long term. You asked me in the last question. But over the long term, Japan's returns have been pretty good. It's just that they compressed those returns in such a short period of time that mean reversion had to sort of rear its ugly head. And you put the really bad period with the really good period, and it sort of evens out. So it just kind of depends. Were you lucky enough to invest in the good period, or did you have bad luck that you invested in the bad period? And how do you reconcile that?
Yeah, it is amazing that their economy was still strong, right? The second biggest economy in the
Yeah.
world through most of that period, surpassed by China in the last several years. But it's not like they were going through their own Great Depression. They still had a great economy. Their stock market just wasn't so great. And we've had that time here in the U.S. We talked about the Great Depression. And not that long ago, we had the lost decade, right? You write about that in the book. And that is the first decade of this century, which I think is a great period to look at because, first of all, it wasn't that long ago. And over that decade, the S&P 500 lost money, two brutal bear markets of losses of more than 50%. The NASDAQ was down 80%, so pretty bad. But as you point out in the book, it may not have been quite that bad if you were diversified.
Yeah, and coming up in my investment career in that decade, I think was really helpful to me in understanding, again, that bad things can happen, but also the benefits of diversification. So a lot of other asset classes did just fine. The S&P, like you said, lost almost 10% of its value in those 10 years. It got cut in half twice, 2 recessions, one of the worst decades we've ever had in the U.S. from an economic and a market perspective. But if you spread your bets and you invested in bonds or REITs or small caps or mid caps or value stocks or international stocks and emerging markets, all these other asset classes still did pretty well for you, actually. Emerging markets was probably the best one. REITs did really well, which is interesting because there was the housing market crash and real estate didn't do so hot. But that was interesting. I mean, I think a lot of people who are newish investors would be surprised to hear that happened because for the past 15 years, 12, 15 years, everyone says, why would I invest in anything besides the U.S., right? That is not what people were saying coming out of 2009. It was, man, we've got to figure out a way to get out of here and go somewhere else and invest overseas or invest in these other asset classes. And I think that's a great lesson, too, of what happened after the lost decade, right? When people were ready to give up on U.S. stocks. And now they come back with a vengeance, and they're the strongest again. And I think that's why diversification can be so helpful but also challenging to people, is that you're always going to have something in your if you're diversified, you're always going to have something in your portfolio that you have to go, ugh, why do I own this? Or if something is doing well, you go, why don't I own more of this, right? So it's kind of a balancing act that you want to just be in the thing that's doing the best, but that's a really challenging strategy as well, because a lot of times the best performer ends up being the worst performer, and then what do you do?
Right. Yeah. That's, I think, one of the other main lessons of your book, the value of diversification. But it's not always easy to stick with because, as you said, there's something is always going to be underperforming. One of my favorite lines about diversification came from financial advisor Lou Stanislavich, who said, if something isn't down in your portfolio, you're not diversified enough. But it's difficult to stick with that. The other line, and I don't know who said it, was with diversification and things like target date funds, you're never going to make a killing, but you're not going to get killed. So you just have to be very comfortable, especially like over the last several years. 2025 was a little different, but since the GFC, owning anything other than the S&P 500 or anything other than tech and growth stocks, you felt like a fool. And not a motley fool, but a lowercase fool. But then 2025 came, and the last few weeks, or so far this year, diversification is paying off a little bit better.
Yeah, I say, like, you're giving up, you don't have the chance for the home run anymore, but you're giving up the strikeout, right? I think, being in extreme position in the markets, obviously that they have people say, like, you concentrate to get rich, you diversify to stay rich. But I think some of that is survivorship bias, that we see the people who've concentrated, but we don't see all the other people who did, and it didn't work out for them, right? Because they took an extreme bet, and guess what happened? They picked the wrong horse to bet on. And I think that's what's so hard. I think the extreme position of higher highs and lower lows, if you're concentrating your investing, It's you just have to have a an intestinal fortitude, just that's like an iron will, and I think that's really hard for some people, and that's what diversification can do for you, is just hopefully make it a smooth ride along the way, even though it can be challenging too. And I think the other maybe big point of the book is just that there is no perfect strategy for everyone, right? This stuff is hard. You can make your portfolio or your investment strategy as simple as you want it to be. And I don't think that there's any one way to invest that's the right way for everyone. I think a lot of it has to do with your own personality. But even if you simplify down to the core, like there's still no easy investment strategy. Everything is hard. You're making trade-offs from one risk or one bet into another.
Right. The old phrase, choose your hard, because nothing's easy. You just have to choose which hard you're happy to live with.
Yeah.
We've been talking about the performance of broad asset classes here, right? Which you can get exposure to through a low-cost index fund. But what about individual stocks, which a lot of our listeners own? Because even though the U.S. stock market has always recovered from every downturn, not every stock does. How do you approach investing in individual stocks?
Yeah, and I highlight the work of Henrik Bessenbinder in here. And he's a professor at the University of Arizona State, and he talks about the fact that over the long haul, the concentration of the U.S. stock market is probably more than you think. His definition of long term is even longer than mine, probably. Right? He's looking at like 100 years of data, and he says basically 60% or so of the companies fail to keep up with T-bills or cash, right, over the very long term. The other, 30% and change kind of more or less keep up with that, maybe a little better. And then something like 4% of all stocks account for all the gains. So it's the big ones, Apple and Exxon and Amazon and Google and Nvidia. And these huge stocks, from a market cap perspective, have given investors all their gains over the past 100 years or whatever. And his point is, there's a lot of different ways to look at it. The one way to look at it is if you own just one of these winners, you're probably set. Like all of your other losers you can offset all of them. So if you're an individual stock picker, as long as you have, again, that intestinal fortitude to stick with a long-term winner like that can pay off a lot of bets. And it's almost like a VC portfolio, like a power law. If you've owned Apple for the past 20 years, it didn't matter how bad you did in your other portfolio picks, like that one offset all of the losers. I think that back to the diversification piece, casting a wide enough net helps too, that you want to make sure that you are able to get some of these winners, right, and have them in your portfolio in some way. And so that's the diversification piece, is if you happen to miss out on a lot of these big winners, it's going to be tough. And the other thing is, obviously, he's looking at 100 years of data. So a lot of these companies that ended up going under and not making it, you could have gotten fantastic returns for 1, 2, 3, 5, 7 years before these companies petered out, right? We're seeing now some huge brand name stocks, Nike and Disney and some of these, really well-known companies that are doing really poorly right now, but owning them historically could have given you fantastic returns, right? So the timing of the ownership too, and sort of when you get in and get out, obviously that can matter too. But my personal takeaway is just like casting a wide enough net to make sure that you own these winners and finding a strategy that sort of forces your hand to hold them and not give up on them. Because I think that can be, it's easy to buy, I think it's easy to sell for an investment, right? I think the holding is the hard part for a lot of people. Because no matter the company, no matter the index, no matter the asset class, you're going to have drawdowns eventually. And then you question yourself, do I lean into the pain and buy more? Do I sell it here and try to just recoup my losses elsewhere? I think that's the hard part for people, is just knowing when to get in, when to get out, and when to like really hold still and not do anything.
Talk about investing in the stock market. You just talked about buying and selling. The buying is, of course, you just with whatever you decide to buy something, or with your 401k contributions, the money's always going in. But then there's the decision about the selling. In your book, you bring up valuations to a degree. You mentioned how high they got during the dot-com bubble and way higher during the Japanese bubble. And these periods usually follow some pretty good years with some pretty good returns. And right now, the CAPE ratio out at the third highest level ever, partially thanks to the S&P 500 returning 13% a year over the past 15 years. Good bit above average. So is there a point where you think investors should say, things are getting a little pricey, perhaps I should take some chips off the table, and is now one of those times?
I think that is a very intelligent sounding article, or a sounding argument that like basically never works. And the hard part is, Peter Bernstein talked about this in his book Against the Gods. I really leaned on him heavily for the ideas of mean reversion. And he said the hard part about mean reversion is when the mean is moving. It's a moving target, right? And I think you can make the case that the valuation, especially for the U.S. stock market, has been a moving target over time. It slowly but surely moved up over time. And the thing is, to your earlier point about this time is different, this time really is different because there's just more tech stocks than there were in the past, and they're more efficient. They're not like having to spend a ton of money on this property, plant, equipment that goes away really quickly, right? And they have to. It's a lot of it is intangible assets, and their margins are really high, and they don't need as many employees as companies did in the past. And so Shiller's data goes back to 1871. Imagine comparing the stocks back then, right? These conglomerates and these railroad companies that had to have massive physical outlay of assets, and it was hard work, and it required a lot of labor and people and spending on that labor. And you don't need that as much anymore with tech stocks. So I think the fact that valuations have been trending higher actually makes sense. And you mentioned the 401k piece. I think that's another part of it. The barriers to entry were so much higher in the past to invest. Right? Even when I first started out, I was telling someone this story recently. I wanted to buy a Vanguard index fund when my first year out of college, and I couldn't because the minimum was $3,000. I didn't have $3,000. Now, there are no commissions, right? If you want to buy a stock, it's free at your brokerage. You can buy fractional shares. The minimums are effectively eliminated, right? You used to have to go down to a brick and mortar place and fill out some paperwork and write a check and wait a few days and then invest. And usually you invested based on whatever that broker told you to invest in. Now you can, on your smartphone, open an account, hook up your bank account, put some money in, invest within minutes. And so I think for like young people, breaking down those barriers to entry has been great. And then you have this automatic investing revolution of money constantly going in 401ks, in brokerage accounts, in IRAs. And that money, you having a consistent buyer of stocks, that has to change the shape of valuations as well. And that's something that's happened over the past 40 years or so. And I think even in the past 10 years, the reduction in cost and the ease of access to the market has to change the valuations. So that's why I think trying to time these things, this is a long-winded answer to explain your question, trying to time these things on valuations is because you have people who pick a line in the sand and go, all right, I'll buy when it gets back to the historical average of 16 times earnings or whatever. And then you realize, okay, that happened once in 2009 for like 6 months. Right. And then it hasn't happened again since. Again, because that average is slowly but surely moving up. So I think trying to time based on valuations, it sounds really intelligent. Geez, stocks feel really expensive here. I'm going to sell. You could have made that same argument for the past 10 years every year. So I do think that trying to do that, you can use valuations to set expectations, I think. I think that's perfectly reasonable. Valuations are way higher, as they should be, because we've been in a long bull market. Maybe my returns will be lower in the future. But does it mean that you should all of a sudden turn off your contributions and sell stocks? And I think that's a harder proposition to get to for me.
Toward the end of your book, you include 10 ways to lose money as an investor, and one is to fight the last war. And you could explain in the book what that means, right? Hedging the big risk after it just happened, buying a black swan fund after the crash already happened, getting an inflation hedge after prices have already risen, basically looking in the rearview mirror for your investing decisions. What's the last war that you think people now might be at the risk of mistakenly fighting?
Well, it's interesting. I feel like this decade has sort of replaced the Great Financial Crisis, which is music to my ears because it was when I worked in the institutional nonprofit space, and after 2008, everyone wanted to sell a black swan fund or a hedge fund or something that would hedge your downside risk. And it was fun. Everyone, all these big, huge institutions controlling billions and billions of dollars. That's all they wanted to invest in, is these things that were take all the volatility away, hedge my downside, and they weren't concerned at all with the upside, right? There was no like, okay, what happens if things keep going up and working? It's like, no, this is career risk. I lost a lot of money. I'm not going to do that again. And that's when I learned about fighting the last war. I'm like, oh, I'm going to invest in what I wish I would have invested before this happened. If we could do it all over again, here's what I would have done. Now I'm going to do it again. And the last risk is rarely the next risk, right? So I actually think it's interesting because I think what investors have been conditioned to do now is the opposite of that. It's no, we buy every dip. We go in, and you saw that last year during the Liberation Day thing where the S&P fell almost 20%. In April, a ton of money poured in. People are now, it's funny, they've been beat over the head for so many years and decades of people telling them, and that's people like you at the Motley Fool, and that's people like me in a blog, hey, when stocks go down, you don't run out of the store because they're on sale, you rush in to buy. And it seems like people have actually learned. And so I make the case all the time that I think investor behavior has actually gotten better over time. I think people are becoming better investors, especially individuals. Mom and pop forever was this nomenclature you use to talk about an unsophisticated investor, right? Oh, they're DIY mom and pop, retail investor. We're the pros. We know what we're doing. If anything, that's changed. The smart money, I think, now resides in retail in a lot of ways. But I think there are a lot of new investors who haven't experienced an extended bear market. 2022 was kind of a decent run-of-the-mill bear market. We were down 25%, and it lasted a year and a half to get back to the highs or whatever. But I think this extended, drawn-out, where you have all these dead cat bounces, and it feels painful, and you're down 35, 40%. There are a lot of investors who haven't experienced that. So I think you see what happens when people have to, they run out of dry powder. Wait a minute, I bought all the dips, now it's dipping again. Now what do I do? I think that's an interesting scenario to think about. When we have an actual recession, we haven't had a real recession in 17 years. Right? We had that 1 month period in COVID, which was essentially man-made. We turned the Nintendo off, blew on the cartridge, put it back in, turned it back on again, and we threw a bunch of money at it. So that wasn't really a real recession, even though unemployment went up. So I think that's going to be interesting to see, like how, I don't know what the psychology will be for people when we have a real recession and a real, drawn-out bear market.
To, of course, invest, you have to save money, and you've written a book about retirement. And when I was starting out in my career in my 20s, it was all save, save, save. Now that I'm getting older and in my 50s, I'm wondering about the balance there. And I'm bringing this up now because you cited a cartoon in your book by Randy Glasbergen. It was basically a guy in a financial advisor's office, and the guy says to the financial advisor, explain to me why enjoying life when I retire is more important than enjoying life now. And you've probably seen this in your life. I know I've seen it in mine, where people save for retirement for decades and then something happens. They have poor health, or they don't actually get the retirement they were looking for. They don't get to enjoy it. So for you, as someone both who thinks about this stuff, has written a book about retirement, and is in the financial wealth advice industry, what do you think is the balance there on enjoying life today versus saving for the future?
Yeah, and I love that cartoon because it does perfectly encapsulate it. Like you, I was always an early saver. I think it was just the way I was brought up, my personality. I was like frugal to a fault in my 20s and 30s, and it probably helped me get ahead in many ways. But I think that mindset can be taken too far. And I think the big change for me was having kids and realizing, like, oh, they're not going to be young forever. And at some point, they're going to want to leave the house, and they're going to want nothing to do with me, probably, right? Or when they're teenagers, so my wife and I had to make a concerted change of, no, we have to enjoy some of this now. What's the point of having a big nest egg when you're older and not enjoying it now? So I think there does have to be some balance. And working in the wealth management field, I've seen countless stories of people who ran a business their whole life. Great, we're going to sell the business, we're going to get a ton of money. Now we're going to enjoy ourselves because I've worked for 80 hours a week for 30 years to, and we had a client who passed away not long after they sold the business. We had clients who were going to retire early and sail around the world, and one of them got cancer and passed away. And so I've seen these stories where you do all this planning and then life throws you a curveball, right? The old saying, like, make plans and God laughs, right? So I do think that there has to be more balance, and that, getting older too, that's been a big thing for me, is just seeing this stuff, losing loved ones and dealing with kids and all this stuff, that there does have to be some balance. And with our clients, we tell them, the whole reason that you delay gratification is to have enjoy it, right? So find ways to enjoy it, to find those things in your life that you're going to enjoy. It's not just about seeing number go up, right? Up and to the right, and I can never spend it. And there's a lot of people who, for 40 years, they scrimp and they save and they have this mindset, and then retirement hits, and they go, I can't see the value of this portfolio go down now. It's got to just keep going up. And you have to kind of retrain your brain to enjoy the money. So I do think giving yourself little pleasures along the way and prioritizing the things that matter to you and spending on those things, you have to make sure you do that along the way too, because if you get too far along the way, it's hard to turn that mindset around.
Let's move on to business and career advice, because I sort of feel like I didn't have maybe a front row seat, but I was in the auditorium to see the growth of Ritholtz Wealth Management and your career. I was an early reader of Barry Ritholtz's blog. I interviewed him way back in 2009. And I've been an early reader of your blog and listener to your Animal Spirits podcast, which you co-host with Michael Batnick. And it's genuinely one of my favorite podcasts. So let's start with Ritholtz Wealth Management. What do you think is the secret sauce to the firm's success?
It's funny. I wish we could have looked back and go, you know what? From day one, this is how we planned for things to go, right? But I read Barry back in the day too. He was one of the first blogs I read. I read him during the Great Financial Crisis, and Josh coming out of that at the Reform Broker. And I was reading those guys, and they kind of inspired me to start writing. And I think the one, if there is a secret sauce, and I don't think there really is, because I think so much of, it's really hard to give career advice because so much of it is just happenstance and chance. And I look at my career, and it could have forked off in 3 different ways if I would have made one different decision, right? And I never would have thought that, like, for me, even producing content was even a possibility back in the day. So sometimes the timing just has to be right. But we all started writing because we enjoyed this stuff, not because we set out to like build a brand and start a company, right? I think people now see the potential benefits of it, and we get questions all the time from people like, hey, I want to start doing content too, and I want to build an audience, I want to build a brand, and I want to do all these things. And I tell people, like, I went into this with 0 expectations. I was not trying to build an audience. I was just, felt like I needed an outlet. I had something I had to say. I was in a career path where I wasn't really, not that I wasn't enjoying it, but it didn't align with my values, my philosophy. I'm kind of a principled person. I think there's a right way to do things and a wrong way. And I wanted to do things my way. And so I was kind of butting heads with the organization I was with, and I thought, you know, I need an outlet, so I'm going to start writing. And it was kind of cathartic for me. But I did it because I enjoyed it. And if I didn't enjoy it, I never would have stuck with it. Because when I first started writing, no one was reading my stuff. But that also gave me a long runway to like get better at it, because I wasn't very good when I first started. I think you can get better at this stuff, right? I was really bad at podcasting when I started, but we worked at it and tried to get better, you know. And I think a lot of these things, some people are just born with these kind of things, right? Some people are born to be great writers. They're born to speak. I don't think I was born with either of those gifts. I think I had to work at it. I think that's something is for people. But my only advice to someone is just put in the time and effort, because a lot of people won't do that. And I think that's probably even more important in the age of AI, where the shortcuts are going to be easier than ever. And I think if you actually do put the time and effort in, and you can kind of stand out from the crowd, I think that's the way to do it. And it's funny, once we all decided, like, oh, people are coming to us. And it's funny, when I started writing, I had these financial publications and financial advisors coming to me saying, hey, I like the way that you explain this stuff in plain English. Can I use this for my clients? And that I never thought of that when I first did it. I was writing, the audience I had in mind was my friends and my family, right? I'm writing for my father-in-law and my mother, so they understand this stuff. That's why I tried to like speak in plain English and sort of not dumb it down, but just simplify and make these complex topics more digestible. And a lot of advisors were going, yeah, our clients, they're not finance people like us that are in this stuff all the time. They have regular lives. They're normal people. They don't have time. They need to like better understand this stuff. And I think we just realized that in the financial services industry, you're not like producing a product where you hand someone the widget at the end of the day, right? This went through our factory, we built it along the way, all the steps, here's your widget. It's a service that requires trust, and in a trust-based, faith-based business, people want to work with others that they sort of like and respect, and communicating with people, whether it's through writing or a podcast or video, is a great way to build that trust. And that's what we learned. And again, we didn't have that figured out on day one, but once we did figure it out, we said, okay, what are ways that we can do this even better? And I think that's what we figured out, is just the trust factor. You kind of narrow the window between a yes and a no from a client, right? Yes, this is a person or organization I work with, or not now that I see what's behind the curtain, I don't really want to, but thanks anyway. So I think that's what we learned, is just how important trust is in this whole process, because financial planning is something that's just never done. You don't just hand someone a binder and go, here you go do it. It's a process. So you got to make sure that you want to work with these people for the long haul. That's a long-term relationship too.
Yeah, I had a simple story. I was a financial advisor with what was then Prudential Securities, and the immediate people I worked with were good people, but otherwise I was put in positions where I was encouraged to sell things that I didn't believe in. So I left and started working at the Bible. I started as an editor, was not a great writer at the beginning, and then just improved it over time. And the podcast part is interesting too, because I wrote literally hundreds of articles before I ever did the podcast. And then I would go to member events and people would always bring up the podcast because I think it's the personal connection, right?
Yeah.
Words on a page, you have personality. We're the Motley Fool. You have a lot of personality in your articles, but it's not the same as that personal connection of having someone feeling like they're talking to you about their investments, and it builds that trust.
Yeah, and I think we underestimated that part of it too. Yeah, you get feedback on your blogs, but you can kind of tailor your blogs and make the, you edit it along the way. And but when you're sharing your own stuff and your people hear you talk, then yeah, you're right. It breaks down those walls even further. And on a podcast, they end up feeling like they know you, right? So you're right. The feedback you get is almost 10 times stronger than something that you write because people they can hear the inflections and hear what kind of person you are and your personality. And I probably should have known this because I'm a listener of podcasts, right? But it's something that you kind of don't understand. And I guess if we're bringing this back to investment analogies, it's kind of a diversification strategy, right? You're casting a wide net to get in front of people. Some people just prefer to read. They want something in their inbox. They want to read it. I still get. It's funny. I hate to be like a generational person here, but the generations of it's older investors tend to still be readers. And I still get emails from people all the time like, hey, how do I print out your articles so I can read it on paper, It's okay. I think I know how old you are probably by saying that. And
right.
Maybe it's younger, middle-aged people who are more into podcasts, and younger people, very young people are more into YouTube and stuff. And so I think one of the things we've learned is you have to kind of go where people are, right? You can't force someone to consume your content just because you think it's great. You have to kind of find people where they're going to consume it.
Final question here, still related to your career. I don't think you're, first of all, giving yourself enough credit for your success, but you pointed out in your book that the best career advice you've ever received is to become indispensable to whoever you're working for. And the way I've expressed it to my kids is always be looking for ways to add value. Don't do just what's expected of you. And you found a way to do that.
Yeah, I think someone told me early in my career, go to your boss and figure out like the 20% of their job that they hate to do and take it off their plate for them. And especially, like you say, as young person, I'm thinking of my kids too. Like, what kind of career advice am I going to give them, especially in an ever-changing world of AI? Because that all these stories about what AI is going to do to the nature of work, that stuff does terrify me, thinking about what it's going to mean for my kids someday. So yeah, you're right. Even if you can't like prepare, plan out your career advice to a T, like I'm going to go down this path and I'm going to get this job and this, yeah, I think being indispensable and just being a person that can be relied on, and I think just solving people's problems. We hired a guy in the last year or so at our firm who came to us and said, I can make the best charts for you. I sent us a chart book. He said, here, check out this chart book. And we were just in the process of overhauling our presentations, kind of saying, like, we need to make this look better. He says, here, let me do it for you. And we didn't even look for it. He became indispensable to us because he was doing something that we couldn't do better, and he could do it better than we could. And now he's part of the firm. We hired him on as like a temp at first, and he became so good that we couldn't let him go, right? So I think that's the kind of thing that matters, is just solving people's problems and making their life easier. Because people aren't going to necessarily go out of their way to be a mentor to you. Like sometimes you have to like make your own way and figure it out. And I think that's the point as a young person.
Well, Motley Fool listeners, if you want to learn more from Ben, check out his blog, A Wealth of Common Sense, his Animal Spirits podcast, and pick up a copy of his new book, Risk and Reward, How to Handle Market Volatility and Build Long-Term Wealth, available on May 12th. Ben, this has been great. Thanks so much for joining us.
Thanks for having me.